This is a podcast from the Business Times.
We usually only look at Forex or foreign exchange when we're going overseas as we want to check how much ringgit, yen or pound the Singapore dollar can buy. But perhaps we should also be looking at it as a viable investment option. However, dipping your toes in the Forex market can seem rather daunting. Which currencies should you be looking at, for instance, and where do you even start? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm your host, Kim Siang. We have with us today Charu Chanana, Head of FX Strategy at Saxo. Hi Charu, welcome to the show.
Hi Kim Siang, thank you for having me.
So, let's say I'm someone who's been investing for a while. I'm experienced enough to invest in equities and ETFs, but now I want to take the next step and look at Forex. What are the essential things I need to know to get started?
Well, first of all, Kim Siang, I would say congratulations, because I think that's a great step towards being multi-asset, towards diversifying your portfolio. It really enhances your returns. If you have a diversified portfolio, it adds a little bit of a stability to your portfolio as well. It could obviously increase your passive income. And then, of course, you kind of prepare your portfolio for varying degrees of, market conditions. So congratulations to you and to everyone else who's really considering jumping into these different asset classes. But certainly, what is Forex? It's about trading currency. So you buy one currency and you sell another one. So always when you talk about Forex, you will see currencies being taken in pairs. Some statistics say that more than 80% of all the trades in the Forex market, you have US dollar on one side. So certainly US dollar is the most dominant vehicle here. But, you have all of these other currencies like euro, like the UK pound, you have the Japanese yen. So you trade one currency against the other, you buy one and you sell another currency. Things that you particularly need to be aware of is which one you're buying and which one you're selling. So there's a standard naming convention for Forex pairs. The currency that is at the front end is called the base currency, and the one which is later on, that's called the quote currency. So you're basically buying the base currency and selling the quote currency. So if you're trading dollar yen, you're basically buying dollar and selling the Japanese yen. The best thing about the Forex market really is that it is extremely liquid, extremely accessible. It trades 24/5 and there's just plenty of opportunities all the time.
So how does investing in Forex compare to investing in, say, equities? What are some of the pros and cons?
Well, I think that when you are already investing in equities, you have the skill sets and you have the knowledge of the markets. And I think it's an easy extension to add Forex to your portfolios as well. But certainly, of course, these are two very different asset classes. The advantages of really adding Forex to your portfolios is, it's a highly liquid market. So you get a lot of opportunities all the time. I think the also important and interesting point of differentiation between Forex and equities is that Forex is highly leveraged. So you can have large positions by putting in even a small amount of your own capital. That makes Forex very interesting, although, I could also use it as a con and say that it's also what makes Forex trading a little bit more risky than equity trading. It is certainly a much more volatile market as well, which means that there's just too many moving parts. There's macro affecting Forex, there's geopolitics, there's political developments. And just being able to track all of that and assess where it goes is, I would say, more complex than doing it for equities. So it's much more complex, much more volatile. And I think also it is a decentralized market. So there's a little bit of a lack of regulation in Forex. So you could be exposed a lot more to counterparty risks or, manipulation risks and so on. So those are things you need to be really aware of.
So you mentioned earlier Forex trading involves leverage. Can you walk us through how that works and how I can use leverage responsibly and effectively? Because leverage, as you mentioned, also increases the risk, right?
Yeah, so it's like the credit cards, right? You are allowed to spend much more than what you really have in your bank account. So it's the same way in the Forex market as well. It enhances your profits, but it also adds a lot more risk that you need to be aware of and you need to manage. I think those are the two things that we really need to focus on. But let me first explain how leverage really works. So the broker that you trade Forex with, they would usually require a percentage of the trade's notional amount to be held in the account as cash. That is what is called the initial margin. Now, this initial margin, it can vary by the broker that you're trading with. It can vary by the FX pair that you're trading with. And it can also obviously vary by the size of your position. So, for example, if you are buying $100,000 worth of euro dollar, they might be required to hold $1,000 in the account as the margin. So that means, your initial margin requirement is 1%. And the rest comes from the debt that you're borrowing from, say, your broker, right? That's how this Forex trading really works. And I think it's really important to understand that this leverage ratio in Forex is very high. It can go from 50:1 to 500:1, which means with a margin requirement of 0.2%. Whereas in equities, the ratio is only about 2:1 or 4:1. You have your capital invested a little bit more in equities. Leverage is a smaller part of your trade compared to Forex. And how do you manage this risk? First thing is be aware, do the maths, answer those fundamental questions around how much of my account value am I willing to risk on this trade? How much profit am I looking to make? Where am I going to close this position? Be ready with those answers before you get into a trade. So being aware of how much you're exposed is very important. But also the second part of it is once you should be able to manage your risk, risk management, have some stop losses, maybe do limit orders. There are multiple risk management techniques that can be used to make sure that your downside is limited and your upside is certainly much more than what your downside is.
So now I've been using the term trading quite loosely, but there is a difference between trading, which is short-term intraday transactions, versus longer-term buying and holding investments. Where does Forex best fit into a beginner investor's portfolio?
Yeah, interesting one. Typically, you would think Forex fits more into that trading basket rather than the investing basket. But I would argue that, in fact, even buy and hold investors should be aware of how they can use foreign exchange in their portfolios. And that's particularly because if you are a diversified buy and hold investor, you have positions in equities beyond your own local market, then you are exposed to some kind of a foreign exchange risk as well. And to hedge that risk, you again need a position in the Forex market. So I think it's important for both. It's important to understand what your trading style is, whether you want to be a day trader, buy and sell in the same day, because when you keep your Forex positions overnight, you also incur a funding cost. Since you're using leverage, you're paying some interest on that funding as well. So if you want to avoid that, you probably tend to be a day trader. You could be a swing trader where you have a price target in mind, and then you can have an open position, say overnight or maybe even up to a few weeks. Or you are a position trader where, you're more fundamental in your view and you're looking at a particular trend. And that position trading, particularly, I would say, is what buy and hold investors can make use of to hedge your Forex exposures in your equity portfolios, particularly.
Still to come, we take a look at how major currencies are doing right now. That's after the break.
In the latest episode of Lens on Singapore, we look at a disturbing global trend and ask the question, is anyone too young for cancer?
Which is when I went to the hospital for a full body check, and that's when they found out more.
Are young adults prepared to deal with the emotional, physical, and financial impact of facing such a daunting medical crisis? The Business Times podcast team goes behind the numbers to get some answers. Listen to Lens on Singapore at bt.sg or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back to Money Hacks. So, now that I've decided I want to give Forex trading a shot, how do I get started in terms of an investing plan?
Well, like you would start investing in any other asset class, I think it's really important first to understand your own trading personality. What are your goals? What is your risk profile like? Are you aggressive or are you going to be a little bit more conservative? Which obviously defines your risk tolerance. It defines how much capital you're willing to use. And in terms of Forex, particularly, it defines how much leverage you're willing to take on your positions, right? And the second thing, which personally I feel is the more important part, is to educate yourself about the asset class you're trying to get into. What are the fundamental drivers? What are the technical analysis that you can make use of? Because even that is very important to kind of determine what your entry and exit levels would be. You need to know what data really impacts the currencies that you want to trade. And what is the calendar of events? Something as simple as that. When is that data? When is that event scheduled? And when should I be on alert to really track that? These are the basics. But when you start making your trading plan, the risk management part is also a very important part of your trading plan. How much capital are you going to put in? Where are you going to put your stops and your limits? And then eventually, I would think that, you should probably have a trading diary, have a P&L, understand where you're making money, where you're losing money, monitor your performance, and then, of course, continue to revise your trading strategy as you move forward.
So what are some of the major currency pairs that beginners should focus on? What's your opinion on how they might perform this year?
Oh, well, that's a very well-timed question because Saxo, we've just launched our quarterly outlook for Q2 2024. Is a very tricky point in the macro cycle where end of last year, markets started to expect the Fed to cut rates. Then earlier this year, we saw a pushback to that expectation around the rate cuts. So I think that is something that is really the main driver of the Forex market right now. Key pairs, the pairs that are the most liquid are euro dollar, dollar yen, and sterling dollar. Sterling is in the UK pound. These are certainly most traded, but it could obviously also depend on what your local currency is. Being here in Singapore, maybe you want to kind of trade dollar Sing as well. There's just plenty of options in the Forex market. Our view really from here on in Q2 2024 would be that we expect the Fed to embrace rate cuts more openly. We've got some pushback from them recently, but I think they are not in a position to delay rate cuts beyond June or July because we have the US election scheduled for November. And the closer they cut rates to the US election, the riskier it gets for their credibility. I could make a case for the fact that the US economy has continued to surprise us with its resilience. But for me, at this point, it remains very hard to argue that the Fed would not cut rates until August. So if you think that the Fed is going to start cutting rates, that gives me a dollar negative view. So I do think that the dollar is potentially going to go down in the second quarter. And that gives a lot of room for recovery in the Japanese yen, which has been trading at 30-year lows. I think sterling is also quite interesting going into the second quarter because of the amount of easing that is priced in for the Bank of England. In my opinion, that is a little bit conservative. We could see the UK disinflation really catching pace in the second quarter, which means more rate cuts will need to be priced in for the Bank of England, which poses some downside risks for the UK's pound as well.
Right. So the thing about currency is that it's not just an investment asset, but it's also what keeps countries and economies going. So it's very much influenced by what you mentioned earlier, macroeconomic conditions. So as an investor, how can I translate news events into investing decisions?
There is no one strategy of trading Forex that fits all. A lot of people ask me at times that, you are obviously sitting in front of a Bloomberg terminal all day, so it might be easier for you. But how do I do it with my regular job and, other responsibilities of the day? It really is about understanding your own trading style, Like I said, you don't have to be a day trader if that doesn't suit you. So if you do not have the time to understand those news, understand that information, I think one very important strategy here is to subscribe to the right news sources. Perhaps I think even more important is to pick the right broker with a well-established asset class expertise who can help you to translate that abundant information into what it means in terms of actionable market strategies. So I think that's very important. But if you do have the time to do your own research and you want to be, like a day trader or be more active with your portfolios, then of course I think it's important to do your analysis, run some correlations, understand how that same data has moved the markets or the Forex pair that you're looking at, how much of a price impact a data point can have historically, and obviously, again, continue to assess your opinions and how they kind of pan out when you start to trade.
Japan recently entered negative interest rates. As a result, the yen has been depreciating, and the government has warned that it might intervene. What's the relationship between interest rates and currency values? How might government intervention impact investors?
So when a country's interest rate is rising, typically that will mean that holding that country's currency becomes more attractive. So investors kind of buy more of that currency. So the value of that currency goes up. Higher interest rates usually translate into higher currency values for an economy. And obviously the other way as well, when interest rates fall, the attractiveness of holding that currency decreases because you're getting less yield on that. So that leads to a depreciation of the currency. Now, what that means is that, you said Japan ended negative rates. That's in a way is a rate hike. So they went from minus 0.1% to 0%. But the Japanese yen is still depreciating. Now, that's counterintuitive. So I think it's a very interesting case that we are having in Bank of Japan. Why this is the case is that when you look at the interest rates, you cannot look at them in isolation for a country. Because you're trading Forex in pairs, you also need to look at interest rates in pairs. When you're trading dollar-yen, a dollar is giving you a rate of 5.5%. And the Bank of Japan, yes, they've raised rates, but to where? They're still at 0%. And that's why that depreciation pressure on the yen is not going away because the yield gap is still significantly large and the expectation around that yield gap closing is not huge as well. You expect the Bank of Japan to hike rates a little bit more, but maybe another 10, 20 basis points. The bulk of that yield gap has to be closed from the Fed side. If they cut rates by 2-3%, maybe in a year, 2 years from now, that's when the yen really kind of starts to recover.
What are some of the common mistakes you see beginners make when starting out in Forex trading? How can I avoid them?
No proper risk management. I think that is a biggest thing that a lot of traders miss out on because they think they're continuously looking at the screen, specifically if they're day traders. But the FX market is so volatile that I cannot emphasize enough the importance of risk management. I think the more important thing that you should potentially be able to avoid is to, allow emotions, maybe fear, maybe greed or hope really to dictate the trading decisions that you're making, which can cause kind of impulsive behavior. It's more psychological than fundamental, but certainly understanding your trading style and understanding the fundamentals forms the core of investing in markets.
Charu, thank you so much for joining us today.
It was a real pleasure chatting with you, Kim Siang.
This has been Money Hacks from the Business Times. I'm Kim Siang. Till next time.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.